I think something that Jonathan and I should do is talk about what people get wrong with multifamily investing. Obviously, Jonathan spends his days, weeks, months, years in the multifamily space. I dabble, certainly more of a residential game, but we certainly interact with a lot of folks that want to invest in multifamily. So I thought we should play the game of ping pong.
Mhm.
You're the guest, Jonathan. I'll let you go first. What is one thing investors get wrong about multifamily?
And is this new investors specifically,
Yeah, new
or
investors.
yeah?
Yeah.
So, well, I was going to joke and say everything, but
Everything.
everything, but that's not true. They don't get everything wrong. Well, one thing that they do get wrong uh, is well, one of the things that I got wrong for sure early on was the debt, right? Understanding the debt, and what I mean by that is that you so if you're used to single family world, right, you're getting a residential mortgage, right, that's based on basically, your income and whether the property appraises at the value that you're buying it at, and hopefully, it appraises better than that. But that's kind of basically what you're getting, right? You're not usually able to get a loan based on the income of the property. And your net worth also doesn't matter. It's really just your income. Can you service the debt? That's all the bank is
Yep.
looking at. And if you go into multifamily with that attitude, thinking like, that's all you need, I just need to be able to, I mean, probably people go in thinking they understand that it's not their personal income that's servicing the debt, it's the property income. But what they get wrong is they don't understand that what the banks are looking for is the property being able to support the debt by a certain sort of excess number, right? Typically, they want the net income to be 25% higher than the debt service at least. That's the first thing. But the second thing is that they want to know what your net worth is, or you and your partner's net worth combined. And this really confuses people because even though they are sometimes looking at non-recourse debt, right? And they're like, well, if it's non-recourse debt, why does it matter? The bank can't come after me for any kind of deficiency if they foreclose. Well, what the banks in the great financial crisis, a lot of people did a lot of fraudulent stuff, or they just kind of walked away from properties, or they just, they basically did a lot of bad malfeasance. Mm-hmm. So the banks decided they had to tighten things up a little bit, and they instituted what are called carve-outs from non-recourse. So basically, if you do there's a certain number of enumerated things, such as committing fraud or taking insurance proceeds that are meant for the property and putting them in your pocket, or declaring bankruptcy in order to avoid paying the debt, or things like that. If you do one of those things, then it becomes fully recourse against you, and then you are on the hook, right? So, and because of that, they want to know that your net worth is high enough to support the loan. So your net worth has to be equal to or greater than the amount of the loan. And then another thing that banks often want to see is experience with multifamily. So then you have a little bit of chicken and egg thing. How am I supposed to buy a multifamily deal if they want me to have already owned one before? Mm-hmm. You can kind of get around these things in a number of ways. One is to have an approved manager. They can supply the experience. One is to have a lot of money. Like if you come in and your net worth is like 10 times the amount of the loan, I think most banks are going to feel like, okay, even if they screw up,
we're good.
Yeah. We'll be all right. But if you're coming in if you barely make it over the line and you have no experience, and you say, hey, I'm going to manage this myself, you may, particularly in this environment, get dinged. So that's one thing.
Yeah, I think the first thing I go back to is just, Grant Cardone and his mantra that bigger is better. And if you don't do 40 units or more, you're a loser, and, all of those things. I think there's a lot of value. And again, Grant Cardone did this in getting a single family home as your first thing. Being a landlord is hard. I could not imagine being a first time landlord with 40, 50, 100, 200, 500 units. It's hard enough sometimes just with one single family home. So I don't think multifamily, I don't believe bigger is better all the time. I believe bigger is better sometimes. And now that sometimes might be the investing environment, sometimes might be the investor, like, hey, you're green, you know, let's start with something a little bit easier, right? You're not going to go fight Mike Tyson, never putting on boxing gloves. That would not end well. Um, I really hate the idea that bigger is better. I get the math, one roof, all of those things, but I don't think bigger is better always. And I certainly don't think bigger is better always for new investors, in my opinion.
Yeah, I'd agree with all of that. I think, and I tell my students all the time, because they hear this stuff, right? And then they think like, oh, I'm a loser because I can't buy 300 units. Or they come to me, they're like, hey, Jonathan, I found this deal that's 300 units. It's like, a $30 million deal. Help me do this. And I'm like, yeah. Like, what are you on? Crack? Right. So I think that I think people should start small, right? Mm-hmm. I mean, start as big as, what I always tell people is actually start as big as you can, like on your own balance sheet, right? So if you can afford to do 100 your first time around, well, do it, right? You're doing pretty well in some other business already, and we can figure out how to put the right safeguards in place. But if you can only afford a 4 unit on your own balance sheet, then start there, right? And that's where you should start. And there's absolutely no shame in starting small. And I'll let you in on a little bit of inside baseball. When I talk with a lot of my syndicator friends are moving small these days. Having done big deals, they're now looking at the world and saying, wow, it is a lot easier to get a small deal done right now. And the returns are better on the smaller deals, right? So
yeah, I agree.
Because you can get them more cheaply. There's less competition for them. So if you can play in that space of like 10 to 40 units, you may find it's a great place to be. And there are people who've made a business on that. Yep.
Yeah, that's where I play. All right, give me number 2.
All right. Well, here's what I just thought of as I was talking about the debt. Valuation of multifamily properties, right? If you're in single family world, you're looking at comps, right? So you're looking at what did the house next door sell for? Or, what's the delta there? Like, and is there enough meat on this bone for me to do the rehab? And what's it going to be worth after I rehab it? And it's all based on the comps. Comps kind of play a role in multifamily, but not really, right? The real valuation is what is the NOI on this property and what is the current cap rate? And that's what tells you what the property is going to trade for. Now, you'll look at other properties nearby to see what they've traded for, just to make sure that you're not like way out on a limb, right? Like, you're valuing this property at 200,000 a door and nothing in the market has ever traded for more than 75 a door. Like, that is a signal to you to tell you, okay, something is wrong here. But you're not really basing it on like, oh, the place next door traded for 75 a door, so mine is worth 75 a door. It could be worth more, it could be worth less, right? You just don't, but it's really based on the income. So that's one thing too. So you have to learn how to underwrite deals. You can't just do it based on comps.
Yeah, my second one is actually from experience. So what I did in 2006 is I started selling or 1031ing my houses into multifamily. And I still remember my first deal on Vassar, still own it today. And I remember my first year of operations, I was shocked at how wrong I was about my assumptions, because all my experience through, I don't know, 30 some odd years was living in a single family home. And now I'd had 8 homes, and I guess I owned them 3 or 4 years. And all my expense factors were wrong. Oh my gosh, turnover. Oh my goodness.
Oh yeah.
Everything was, and again, maybe I should have known better, but I didn't. And I just want to admit the reality that the expense structure was vastly different. Turnover was vastly different. You're suddenly a counselor a lot of times, right? You're not really a counselor in a single family home. You are in a multi-unit with, doors, 20 feet apart or whatever they are, shared walls. And I was shocked by that.
How much higher were the expenses than you anticipated?
They were at least 20% higher, and most importantly, turnover was 4 times higher than I expected, right? My houses average 8 years. Now, after 15 years of this, my apartments are less than 2 years.
So yeah, I mean, the industry standard forever in multifamily was 50% turnover a year, right?
yeah.
It has gone down to about 35 as this because of the supply crunch, and people don't move because there's just
Mhm.
not nowhere to move to. So
Right.
they're a lot more stable than they used to be, but still you've got 35% of your tenants moving out every year, which means that you've got turn costs, right?
Yeah.
Which will kill you. And I learned that too. In my first property, I was like, damn, why is this costing so much money? Right? All
Mhm.
the profits are going out the door in turns. So
Yep.
that, I mean, this wasn't on my list, but this is another thing that people get wrong about multifamily. When you listen to people talking about multifamily and selling you a course or something, what they'll say is, oh, yeah, go in and raise rents and just
Yeah.
keep on raising rents. And well, yeah, that sort of works well on a spreadsheet. The problem is that if you raise rents too aggressively, you
Yeah.
lose tenants, your turnover goes up, and then your turn costs just kill you, right? Because
Yep.
you've got vacancy cost and you've got turn cost, right? So that can be, you know, let's say vacancy cost is 1 month of rent, and turn cost, you know, could be 2 months rent, depending
Could
on
be. Yeah.
could be on how badly the apartment has been damaged or how long that tenant was there. So you may be
For
looking
sure.
at them and going, oh wow, they're 500 bucks uh below the market, right? But you could
Yeah.
very easily on that, you know, that's $6,000 delta a year. You could very easily spend that $6,000 on the turn, right?
Yeah. Yeah. You
So
get one wrong turn, it could be 6 grand. Yeah.
yeah, exactly. So that's something that you have to be aware of in multifamily, and you have to manage and underwrite appropriately. So getting a handle on your turn costs is really critical.
Yeah. I agree. Well, give me your last one. We're going to do three each. What's your last one?
Okay, last one. I would say that the last one is that you need a lot of money to buy multifamily property.
I
And I
like that.
would say that this is actually not true, because as not that you can't partner on houses. I mean, you absolutely can. You could find partners to help you with the money, but I think it's a lot easier with a bigger deal to uh to find people to, you know, invest with you or alongside you, and there's just more meat on the bone for you to kind of, you know, split up the profits so that it's still worth your while, even though you don't own the whole deal yourself. You know, if you're clearing $150 a month on a property, um, you know, a single family, and then you split that up with someone else, it's kind of like, is it really worth my effort for 75 bucks a month? Whereas
Yeah.
if you've got, you know, if you've got a 10 unit and each one of them is clearing 150 bucks a month, and then you're giving away half of that to some investors, well, you're still making, you know,
Yeah.
almost $1,000 a month, right? So it's well, maybe my math is wrong. 800 bucks, 750. I mean, it's real money, right? So
Yeah.
it's worth your while. And if you start stacking those up, then suddenly, you know, you've got financial freedom because you've got, you know, 10,000
Yeah.
bucks a month coming in as income. So that's the thing about multifamily. It is easier to split it up, and it is easier to find investors to
Yeah.
come in alongside you.
I like that one. Well, the last one I'll close with again is my practical experience. A lot of people talk about the real estate market having one cycle. At least for me, over my last 22 years, the single family market and the multifamily market where I play, they do not operate at the same cycle. When one's up, the other can be down. When one down, the other could be up. There is not one real estate cycle. There could be several, right? There's a cycle like we're seeing one today. There's a cycle for office. There's a cycle for residential. There's a cycle for this. So again, folks, if you're going to do the work and track it, don't assume that because you understand single family, you're going to understand multifamily, because there are lots of variables and intricacies that will make that assumption a very bad one, in my opinion.
Yeah, and multifamily investors are guilty of this sometimes too, because what you see people in multifamily saying, "Oh, if it's hard to buy homes, then then everyone's going to come and rent," and that
Mhm.
isn't necessarily true, right? So just understand the thing that you're investing in is the lesson.
Absolutely. Jonathan, where can people find you?
So please come and join my Facebook group at Apartment Investors Club on Facebook, or you can come by apartmentinvestorsclub.com and get my free download, or you can Google me at Two Bridges Asset Management and fill out my investor form if you're an accredited investor. And I actually have an active deal going on right now. So if you're interested in learning more about that, come on by.
Awesome. Thank you so much.